Let's be honest. When you put money into your brokerage account, you just trust that it's safe, right? You assume the platform's solid, the company's not going anywhere, and that your stocks and your cash are, well, that they're yours. But as we're looking at the financial world of 2026, it is really time to take a closer look at that trust. Is your broker really the fortress you think it is? Let's find out. For most of us, a brokerage account feels just like a bank account. It's where our money lives, we put funds in, we take them out, and in between, we use it to buy and sell in the markets. It's our main gateway to trying to build some wealth. But that simple comparison, that idea that it's just like a bank, that's exactly where the danger starts.
So here's the big question. Is that assumption even correct? Is your brokerage account really the digital vault you imagine it to be? Well, the answer, as you're about to see, is a lot more complicated. There are layers of risk here that most people never even think about until it's way too late.
So here's our game plan. We're going to peel this whole thing back, layer by layer. First, we'll shatter what I call the brokerage illusion. Then, we're going inside the machine to look at risks you can actually control. We'll get into the counterparty conundrum, see the domino effect in action, and then look ahead to the 2026 horizon. And stick around, because at the end, we're going to build your personal risk framework so you can take back control.
Okay, first up, the brokerage illusion. If we're going to get a real handle on the risks we're facing, we have to start by tearing down our most basic assumption that our broker is just a simple, neutral vault holding our stuff.
Let's just get one thing straight right from the start. This is a hard truth that's behind everything else we're going to talk about. All investing has risk. That's not just some legal mumbo-jumbo in the fine print. It's the iron law of the market. The chance for reward is always chained to the chance for loss. And here's the kicker. Managing that risk, that's your job. It's not your broker's.
All right, let's get practical. Let's look at the risks that are literally at our fingertips, the ones connected to the platforms and the tools we use every single day. This is the area where you have the most direct control over your own fate.
So your first choice is your broker, and you can think of it like picking a vehicle. Do you just need a simple, cheap car to get you from point A to B? Well, that's kind of like a discount broker. Or do you need a huge truck with every feature imaginable, maybe even a professional driver to help you out? That's your full-service broker. Your choice really depends on what you need, but getting it wrong can be a really expensive mistake. Next up is the software itself. Are you using a web-based platform that you can access from any browser, just like you check your email? Or are you using a client-based platform? A heavy-duty program you download onto your computer. The web gives you convenience, for sure, but the client often gives you more power and speed. One isn't necessarily better, but you have to understand that they have different workflows and, more importantly, different ways they can fail on you. Now listen up, because this one is huge. You can have the best, most brilliant investment idea in the world, but it can all get wiped out by something we call pilot error. This is when you lose money not because you were wrong about the market, but because you made a simple mistake. You fat-fingered a number, clicked the wrong button, put a decimal in the wrong place. In that moment, you become the single biggest risk to your own money.
Just look at the anatomy of a single trade. It's kind of scary how many landmines are hidden here in plain sight. Every single step is a potential place to mess up. Did you mean to use a market order or a limit order? Did you type 100 shares or did you accidentally type 1,000? Every click is a decision, and one tiny mistake can have a massive, and I mean massive, unintended consequence.
This right here is your first and most important line of defense. A market order gets you in or out right now, but you might get a terrible price. A limit order makes sure you get your price or better, but hey, it might not fill at all. And a stop order, it's not even an order. It's a trigger that fires off a real order when a certain price gets hit. Knowing which tool to use for the job is absolutely non-negotiable. Okay, let's go one level deeper. We've covered the risks you can control. Now, let's talk about a risk that's a whole lot harder to manage. The company you've trusted with your money. What happens when your broker becomes the problem? Ever wonder how free trading is actually free? Well, here's how. Brokers have a ton of ways to make money that have nothing to do with commissions. They get paid to send your trades to certain market makers. That's called payment for order flow. They make interest on the cash you just have sitting in your account. And yep, they can even lend out your stocks to people who want to short them, and they collect a fee for it. Their business model isn't always perfectly aligned with what's best for you. And the whole GameStop saga is the perfect, explosive example of what happens when a broker's business gets pushed to the absolute limit.
The price swings were so insane that the clearinghouses, the guys in the middle of all the trades, demanded billions in extra cash from brokers like Robinhood. So Robinhood had a choice: risk their entire company going under or just turn off the buy button for their customers. They chose to survive. Your ability to trade just vanished, not because of a market rule, but because your broker was saving its own skin.
This risk gets even crazier when you're talking about crypto. With stocks, your ownership is pretty clear. But when you hold crypto on a big exchange, your coins are basically just tossed into a giant digital pot with everyone else's. So if that exchange gets hacked or goes bankrupt, you don't have a direct claim to your specific coins. You're just another unsecured creditor standing in a long line, hoping to maybe get a few cents back on the dollar. That saying, "not your keys, not your coins," it's a very, very literal warning about this exact risk.
And all of this leads to one single unavoidable truth. Your broker is a business. Their job is to gather assets and make money. They are not your financial guardian angel. So at the end of the day, you have to be the CEO of your own capital. Because trust me, no one else is ever going to care about it as much as you do.
All right, now we're zooming way out. We're going to the macro level, to the massive forces that can sink the entire market, no matter how great your stock picks are or how carefully you've managed your trades. You know, the best way to think about systemic risk is to imagine you're on the Titanic. As a passenger, you have absolutely zero control over where the captain is steering the ship, or if there's a giant iceberg floating out there in the dark. The ship might be doomed. But what you can control is whether you have a plan to get off. You can control whether you've secured a spot on a lifeboat. In the world of investing, that lifeboat is your exit plan and your portfolio hedges. So, what's a potential iceberg we can see on the 2026 horizon? Just look at this number, $1.8 trillion. That's the wall of maturity. It's the amount of commercial real estate debt that all comes due and has to be refinanced by 2026. Here's the problem. Those loans were made when interest rates were basically zero. Trying to refinance them at today's much higher rates could be impossible for a lot of property owners, and that could trigger a wave of defaults that rattles the entire banking system.
And hey, if you're sitting there thinking, "Phew, I'm safe because I diversified into crypto," well, I've got some bad news. That whole digital gold idea has kind of fallen apart. The data from 2026 shows a 70% positive correlation between crypto and stocks, especially when the market is under stress. When people get scared and start selling risky things, they sell crypto and stocks at the same time. It's not acting like a safe haven, it's acting like a risky tech stock on steroids. So if that kind of diversification isn't really working, then what's the answer? Well, it's finding assets that have inverse correlation. This is the whole key. You need to find something to put in your portfolio that is specifically designed to go up when all your other stuff is going down. It's like a financial seesaw. And this is a brilliant practical way you can build that lifeboat. Check out this table showing an inverse ETF. If the Dow Jones ETF, that's ticker DIA, goes up 1%, the inverse ETF, ticker DOG, goes down about 1%. But if the market tanks and DIA drops 1%, DOG goes up 1%. Buying an asset like this is basically like buying an insurance policy against a market crash. It gives you a way to potentially profit from the chaos. Okay, let's shift our focus now from the dangers of today to the disruptions of tomorrow. The financial world is really on the edge of some major upheavals, from technology to regulation, that could completely change the rules of the game as we know it.
The biggest technological wave coming our way is, without a doubt, decentralized finance, or DeFi. You see, traditional finance, TradFi, runs on middlemen. Brokers, banks, exchanges, they all stand in the middle and take their cut. DeFi wants to replace all of them with software. It uses algorithms and smart contracts to let people transact directly with each other, peer-to-peer, cutting out the middlemen completely.
And the ambition here is just staggering. We're not just talking about stockbrokers. DeFi protocols are being built to replace exchanges, banks, insurance companies, even mortgage and title companies. The goal is to automate the entire financial industry, which, as you can imagine, is a pretty serious threat to the business model of the broker you're using right now. Another huge risk we see on the horizon is a potential AI bubble. By 2026, companies are on track to spend over $2 trillion a year on AI. But there's a massive gap between all that money being spent and the actual revenue that AI is bringing in. If the profits don't show up to justify that massive investment, we could see a really painful correction in the stock prices of anything related to AI. And if you want to see just how wild things have gotten,
Get a load of this number. In 2026, a company like Palantir is trading at a price-to-sales ratio of 110. Let me say that again. Not price to earnings, price to sales. That means investors are paying $110 for every $1 of revenue the company makes. That is the kind of speculative mania that historically does not end well.
And finally, on the regulation side, the walls are closing in. As of January 1st, 2026, this thing called the Crypto Asset Reporting Framework, or CARF, takes effect. It basically forces brokers and exchanges in over 75 countries to automatically report all of their users' crypto transactions directly to the taxman. The old idea of using crypto to hide money or dodge taxes? Yeah, that's officially becoming a thing of the past.
Okay, deep breath. We have peeled back a lot of layers of risk, from your own mouse clicks to your broker's business model to massive systemic threats. It can seem like a lot, but now this is where we bring it all home. How do we build our own defense system and actually take back control?
It really all comes down to this one powerful idea. You can't eliminate risk. It's impossible. Absolute safety is just an illusion. But what you can do is increase your level of control. The more you control your tools, your strategy, and your exposure to these threats, the more you can reduce the risks you're facing.
And we are back on the Titanic. You can't stop the iceberg. You can't control which way the market is going to go tomorrow, but you can build your own lifeboat. And the single most important part of that lifeboat is having your exit strategy figured out for every single position before you even get into it. You have to know how you're getting out before you get in.
So what does this framework actually look like? Think of it as a 5-point shield. First, know your tools. Master your platform to avoid those self-inflicted wounds from pilot error. Second, understand your broker's risk. Know how they make money, because their interests aren't always your interests. Third, diversify your counterparties. Don't keep all your eggs in one institutional basket. Fourth, actively hedge against those big systemic icebergs out there. And finally, the golden rule that sits on top of everything else: have a predefined exit strategy before you even think about hitting that buy button.
And that brings us to the final and most important question you have to ask yourself. When it comes to your money in your financial future, are you just passively hoping that everything's going to be okay? Or are you actively building a solid framework that's designed to survive the storms that are definitely coming? The choice and the control is yours.